You know, when we gather around charts and tape readings, we're really gathering around human nature itself. And today, as we explore the top 3 secrets of the Composite Man, it naturally brings me back to something we touched on in the previous video on the discipline secret that saves traders. Because without discipline, none of these insights can take root in your mind or your method. Now, if you followed my work, you know I always spoke of a master operator, the Composite Man, an imaginary figure who represents the combined action of the strongest hands in the market. He's not mystical, though people sometimes treat him that way. He's simply the large, informed interest that guides the market from accumulation to markup, distribution, and markdown. If you learn to think as he thinks, you begin to understand why price does what it does. And if you understand that, well, you start trading with far more calm and clarity. But let me ask you, have you ever found yourself chasing price without asking who might be on the other side of your trade? The first secret the Composite Man would teach you is this: he operates with a plan long before the public ever suspects a move is coming. His success doesn't begin at the breakout, it begins in the dull, slow corners of the chart where most traders lose interest. This is why accumulation looks so quiet. It's deliberate, it's controlled, it's methodical. Think of it like you're slowly building a position in a stock you believe in. You wouldn't rush. You wouldn't telegraph your intentions. You'd take your time, wouldn't you? The Composite Man accumulates where the crowd is bored or discouraged, and he distributes where they're excited and greedy. If you've ever felt confused during a choppy range, that confusion is often the footprint of preparation. And if you've ever wondered why your trades seem to trigger just as the market reverses, ask yourself, were you reacting emotionally while someone else was acting strategically? This brings us to the second secret. He uses the public's impatience to his advantage. Not in a predatory sense, but in a natural one. Most traders are in a hurry. They want action. They want confirmation. They want certainty. But markets rarely give certainty to those who demand it. The Composite Man, instead, waits, quietly marking up inventory after accumulation or unloading positions during distribution, and he uses tests, shakeouts, and springs to see who's still holding and who can be pushed out. Have you ever noticed how the cleanest trend moves often follow the ugliest fake outs? The Composite Man understands that if he wants to buy large amounts, he must first create conditions where selling pressure appears. And if he wants to sell large amounts, he must create demand. This isn't manipulation so much as it is the natural mechanics of large volume operating within thin price zones. When you think from his point of view, you stop viewing volatility as danger and start seeing it as information. You start asking, what purpose is this move serving? Is it drawing in the crowd or scaring them out? And this is where your mindset comes in. A trader who reacts emotionally becomes part of the Composite Man's liquidity. A trader who studies calmly becomes a partner in his campaigns. This is why chart reading is inseparable from wealth building. The more clearly you interpret intent, the more selectively you take trades. And selective trading preserves capital, preserves confidence, and preserves longevity. Isn't longevity what most traders overlook when they think too much about quick gains? Now, before I move into the final secret, let me remind you how today's principle dates back to the previous discussion on the discipline secret that saves traders. Because understanding the Composite Man is pointless will that await through their discipline to ways work is being done. Your discipline is the foundation that allows you to read these intentions without jumping ahead of the story. The third secret, and perhaps the most misunderstood, is that the Composite Man reveals his motives. If you watch the relationship between price and volume closely enough, price alone will fool you. Volume alone will mislead you. But the two together tell a story. For example, after a strong rally, if volume dries up while the price drifts sideways or slightly down, he's often testing supply. He wants to know, are weak hands offering shares cheaply? Has the selling been exhausted? If the answer is yes, he can resume markup. But if heavy selling appears, he must reassess. As a trader, when you see these clues, you gain a sense of rhythm, not prediction. not certainty, just rhythm. And rhythm is what keeps you from reacting out of fear. It's what stops you from jumping into trades that don't reflect the composite man's purpose. Have you ever entered mid-trend only to realize later that the move was already mature? That's rhythm, or the lack of it. Consider also how the composite man behaves around climactic moments. A buying climax accompanied by massive volume and sharp price thrusts often signals distribution underway. The public sees strength. The composite man sees an opportunity to unload stock at premium prices. And this is where your money mindset truly matters. If you're too focused on quick wins, you'll chase the climax. But if you're focused on reading behavior, you'll recognize that strength isn't always strength and weakness isn't always weakness. Doesn't that realization alone change how you approach trading? You start to understand that your role isn't to predict the market, but to interpret it. To observe calmly, to follow the path of least resistance, rather than forcing your will onto the chart. When you can do that consistently, you begin to trade less frequently but more effectively. You stop seeking excitement and start seeking alignment with the larger forces at play. And isn't alignment what every trader is really looking for, even if they don't yet have the words for it? The more you watch how price responds to volume at key levels, the more you see the composite man's decisions unfold. You start noticing when a test holds, when a spring is genuine, when distribution is stealthily forming. And once these patterns become familiar, they stop feeling mysterious. They simply feel logical, natural, almost obvious, but only in hindsight unless you train your eye. And training your eye requires patience, study, and the willingness to sit through those quiet periods where the composite man is still building or unwinding his position. That's where most traders lose focus. They want constant action, not the patient accumulation phase where wealth is quietly built, but that quiet phase is where the real opportunity lies for those who can wait and watch without forcing trades they don't need to take. Because the composite man never forces trades. He waits for the market to come to him. When we talk about thinking in terms of the composite man's long-range plan, we're really talking about a profound shift in how you read markets, how you interpret price, and how you position yourself as a trader. Most people look at a chart and see a collection of candles or bars moving up and down. They treat every tick as isolated, every swing as spontaneous, every rally or reaction as something that just happened. But if you adopt the mindset of the composite man, a concept Richard Wyckoff used to explain the intentions of large, informed interests, you start seeing the market as a carefully crafted campaign rather than a chaotic battlefield. This single mental adjustment can change the entire way you trade because it pulls you away from emotional reactions and shifts your focus toward the bigger purpose behind each move. To think in terms of the composite man's long-range plan, you must imagine that a powerful operator is guiding the action, not manipulating it in some sinister way, but moving strategically because he must handle large quantities of stock without disrupting the market too aggressively. He can't buy everything at once. He can't sell everything at once. He must build positions, test supply, shake out weak holders, and create the conditions that allow him to complete his campaign efficiently. Have you ever found yourself wondering why markets move slowly and erratically before a major trend emerges? That's because accumulation and distribution are processes, not events. When you assume this operator exists, every phase of the chart becomes part of a story, and every movement has intent behind it. Instead of asking, is this bullish or bearish, you begin asking, what is the composite man trying to accomplish here? That's a more powerful question because it forces you to look beyond the surface. For example, if price is drifting sideways in a tight range with gradually decreasing volume, the untrained trader may see boredom or indecision. But if you're thinking like the composite man, you might recognize that this is an accumulation phase, quiet, patient, and deliberate. You start noticing that he is absorbing supply at lower levels, preparing for a future markup when the time is right. This is very different from the typical trader mindset that focuses on breakouts, indicators flashing signals, or news catalysts. The composite man doesn't care about your indicators. He cares about inventory, how much stock he can acquire, how much he can distribute, and at what price levels he can do both efficiently. And this is where most traders get outplayed. They react emotionally to noise, while the composite man is steadily working his plan. Have you ever chased a breakout only to see it reverse instantly? That's often because you were stepping in right when the composite man was finishing his business. Thinking according to his long-range plan also means recognizing that campaigns take time. The composite man may spend weeks or months accumulating before he marks up the price. This slow work is necessary because he cannot acquire everything he wants in a single day without pushing the stock sharply higher, which would undermine his own plan. So he creates an environment where the public becomes disinterested or fearful. He keeps the action dull enough that most traders lose patience. And once those weak hands are shaken out, he can accumulate more easily. When you think this way, you begin appreciating quiet markets instead of being frustrated by them. You start seeing opportunity where others see stagnation. And what about the long-range plan during distribution? The composite man cannot unload large quantities into a falling market because there isn't enough demand to absorb it. Instead, he needs rising prices, excitement, and public enthusiasm so he can distribute into strength. If you think from his perspective, you understand why the most dangerous moments for the public are often the most thrilling. Sharp rallies, heavy news coverage, new highs. These are the moments when the composite man quietly sells to eager buyers. You begin to understand why strength is not always real strength. Doesn't that change the way you interpret a surge in price? Instead of celebrating, you start questioning, is this genuine demand or distribution disguised as optimism? Moreover, thinking in terms of the composite man's plan requires you to stop fixating on the next trade and start focusing on the larger structure of the market. Every trend, every range, every spike is part of a broader narrative. You begin mapping out campaigns, accumulation leading to markup, markup leading to distribution, distribution leading to markdown. These phases repeat because the intentions behind them remain constant across decades. And once you internalize this, your entire approach becomes calmer. You stop trying to force trades where no real opportunity exists. You wait for evidence that supports the phase you believe the composite man is in. You begin respecting the ebb and flow of supply and demand instead of trying to predict random fluctuations. The composite man's plan always revolves around absorbing stock cheaply and selling it at a premium. That's the essence of trading, yet most traders do the opposite because they focus on emotion rather than intention. They buy at exciting highs and panic at dull lows. When you step back and view the chart from the composite man's point of view, you start positioning yourself alongside the informed interests rather than the crowd. And this shift doesn't require complicated systems. It requires understanding human behavior and market structure. Every time you analyze a chart, ask yourself, where could accumulation be taking place? Has supply been tested? Who benefits from this move? These questions align you with the long-range plan instead of chasing short-term noise. By approaching the market from the composite man's perspective, you develop patience, clarity, and a deeper understanding of the forces shaping price action. You stop seeing the market as random and start seeing it as a sequence of intentions playing out over time. And that mindset allows you to trade with far more confidence and discipline, because you're no longer fighting the tide. You're reading it, adapting to it, and aligning with the operator who moves the largest waves. Accumulation occurs when most traders are bored, not when excitement is present, and that single idea explains more failed trades than most traders ever realize. When you hear it, it sounds simple, almost too simple, but if you look closely at your own trading history, you might notice a pattern. The trades you chased in moments of excitement rarely carried you far, while the quiet, dull areas of the chart, those you ignored, often marked the true beginnings of major moves. Why is that? Because large interests, the kind Richard Wyckoff referred to as the composite man, do not accumulate during highly emotional market moments. They accumulate when no one else is paying attention. If you think about it from their perspective, it becomes obvious. If you wanted to build a very large position, would you do it during a time when everyone else is eager to buy? Of course not. Buying aggressively during hype drives the price upward and makes your own job more expensive and difficult. Instead, you would choose a time when few are watching, when volume is lower, and when price sits comfortably inside a trading range. You would prefer an environment where impatience and boredom are washing out weak holders, causing them to sell without much resistance. Have you ever noticed how those long, flat trading zones feel almost impossible to sit through? Most traders lose focus in these periods. They become restless. They want movement, signals, confirmation, something to prove that a trade is worth taking. But the composite man embraces stillness. He welcomes dullness. Quiet markets are the perfect environment for accumulation because they allow him to absorb supply gradually without alerting the public. Every time price dips toward the lower boundary of the range and hesitant sellers unload their positions, he can acquire more at a discount. And because the volume is modest, his activity doesn't draw attention. In fact, it blends into the background noise, unnoticed by most. This is why Wyckoff always emphasized the importance of studying trading ranges deeply. They are not meaningless congestion. They are often the birthplace of major campaigns. The problem is that boredom blinds the public. Traders want action right now, not later, so they look elsewhere, jumping from chart to charting for something that feels exciting. Meanwhile, in that very range they dismissed, the composite man is quietly building his foundation for the next major move. Doesn't it almost feel like the market punishes impatience and rewards attentiveness? Let's consider what boredom does psychologically. When a trader feels bored, they are more likely to anticipate prematurely, exit too early, or ignore important subtleties. They read the market with less care. They stop studying volume characteristics. They stop asking questions like, who is buying down here? Why isn't price breaking down further? Why does the range refuse to collapse despite weak sentiment? By failing to observe these details, they fail to recognize accumulation for what it truly is, a slow, steady absorption of supply that sets the stage for future strength. During accumulation, you will often see declining volume on down moves and slightly increased volume on up moves within the range. This doesn't look dramatic. It doesn't feel like a signal. Yet it's evidence of strong hands supporting price and weak hands offering shares. The composite man wants sellers to become exhausted. He wants them to give up. The best way to create that exhaustion is not through dramatic price action, but through time. Time wears traders down. Time causes them to doubt. Time pushes them out of positions they would have benefited from if they had only held on. And while they gradually exit, the composite man continues absorbing. This process explains why major moves often begin immediately after most traders have given up watching. Once supply is sufficiently absorbed, price no longer falls easily. The path of least resistance shifts upward, but the breakout that follows is often sharp and quick because little supply is left to hinder movement. Traders who ignored the range suddenly feel they are late, and they jump in emotionally, exactly when the composite man is ready to mark up price, not accumulate. Another important factor is sentiment. During accumulation, sentiment is typically negative or indifferent. News isn't favorable. Social discussion is quiet. Traders are complaining, not celebrating. Markets feel slow, tired, or uninteresting. And this emotional backdrop is exactly what allows accumulation to happen smoothly. Strong hands prefer buying when the public feels uncertain. They prefer accumulating when pessimism has driven prices to levels that no longer reflect value. Have you ever noticed how some of the best long-term opportunities appear after markets feel dead? Because accumulation occurs in these dull environments, traders must reshape their mindset. Instead of avoiding boredom, they should study it. Instead of assuming that quiet equals unimportant, they should look for the subtle clues that reveal hidden strength. This is where discipline plays a huge role. Patience is not just a trait, it is a tool. Without it, you cannot sit through the slow, grinding phases where large operators do their work. Without patience, you end up trading the surface rather than the structure. Learning to appreciate accumulation means training yourself to see dullness differently. A flat chart doesn't mean nothing is happening. It means something important may be happening beneath the surface. Each small rally and reaction, each test of the lower boundary, each shift in volume tells part of the story. And when you start reading those details, you slowly become less dependent on excitement and more focused on behavior. You start recognizing that the best opportunities rarely scream for attention. They whisper quietly while the crowd is too distracted to notice. Accumulation is a patient phase, a strategic phase, and a phase designed to disguise intention. It thrives in environments where boredom pushes traders away. By understanding this, you begin aligning yourself with the composite man's timing rather than the public's impulses. Distribution is hidden inside strength that looks attractive to the uninformed crowd, and once you truly understand this, the entire character of market trends starts to look different. Most traders have been conditioned to believe that rising prices automatically signal opportunity, but in the Wyckoff framework, strength must always be questioned. Not doubted blindly, just interpreted with a deeper eye, because what looks like bullish enthusiasm on the surface may actually be the composite man quietly unloading his inventory. Have you ever chased a strong breakout only to watch price collapse shortly after? That moment of confusion is often the result of mistaking distribution for genuine demand. To grasp this concept, picture the composite man holding a very large position that he wants to sell. He cannot simply dump everything into the market, because doing so would overwhelm demand and cause price to crash prematurely. Instead, he needs buyers, enthusiastic, willing buyers, to absorb his supply. And when do buyers become most enthusiastic? During upward moves, during news-driven optimism, during emotional breakouts, during the exact moments that feel safest to the average trader. This is why Wyckoff emphasized that distribution is not a single event, it is a campaign. A carefully orchestrated process spread over time. When distribution is happening, price often appears strong. It may drift upward gradually, forming higher highs or sitting near the top of a range. Volume may increase on rallies, not because informed interests are buying, but because the public is. The composite man sells into that strength, feeding the demand created by the crowd. This process can continue longer than most traders expect, because the market doesn't fall until supply finally overcomes demand. Until that tipping point, the illusion of bullishness persists. Doesn't it make sense that large operators would prefer to sell when enthusiasm is high rather than when fear dominates? Another hallmark of distribution is choppiness, not wild volatility. Just enough back and forth movement to confuse traders. You'll often see false breakouts above the range, quick rallies that fail, or tests of new highs that lack momentum. These movements are not random. They serve a purpose. The composite man may use upthrusts, false fast breakouts to attract breakout buyers. Once those buyers commit, he quietly places more sell orders, offloading shares at advantageous prices. The public sees strength. The composite man sees liquidity. It's a subtle but crucial distinction. Volume patterns also play a major role in reading distribution. During a distribution phase, you may notice that volume expands on up moves but contracts on down moves, an inversion of what you often see in accumulation. This doesn't necessarily mean strong demand. It often means heavy selling disguised within rising prices. The bars look bullish, but the underlying activity is bearish. If you've ever watched a stock climb beautifully and then suddenly roll over without warning, it may not have been sudden at all. The groundwork for that decline was likely laid quietly during the preceding distribution. Trader psychology amplifies this effect. When a market looks strong, people become confident. When they see price pushing higher, they believe the move is real, especially if they've been waiting for a safe moment to enter. The public's desire to avoid missing out creates a perfect environment for distribution. This emotional component is why distribution often peaks near euphoric sentiment. Think about how often markets top when everyone is talking about a certain stock or sector. That excitement provides the composite man with exactly what he needs. Buyers willing to take shares off his hands. In distribution, tests are also crucial. Just as accumulation includes tests of supply, Distribution includes tests of demand. The composite man wants to know whether buying pressure is weakening. After a rally, price may pull back slightly with low volume. If the pullback holds and buyers step back in, he may continue distributing. But if a test shows that demand is drying up, he may begin preparing for the markdown phase. These tests can confuse traders because they often appear as harmless pauses or sideways movement. But if you read the behavior through the lens of intention, you realize they're signals of shifting control. One of the most telling signs of distribution is that upward movement feels forced. It lacks the smooth, natural character of genuine markup. Rallies become shorter. Reactions become deeper. Breakouts fail more frequently. Yet to the untrained eye, the market still looks bullish enough to justify buying. That's how the composite man is able to complete his distribution quietly. He relies on the crowd misinterpreting surface level strength. What often shocks traders is how quickly the decline unfolds once distribution is complete. The moment supply overtakes demand, price no longer floats upward. It starts sliding, sometimes slowly at first, and then with increasing momentum. Traders who bought near the highs suddenly find themselves underwater. They panic. Their selling accelerates the markdown. This is why the Wyckoff method is so powerful. It gives you a chance to understand the turning of the tide before the public realizes anything is wrong. To think properly about distribution, you must detach from the emotional pull of rising prices. You must learn to question strength, to analyze whether the behavior matches true demand or masked supply. This doesn't mean becoming cynical, it means becoming observant. Every upward movement has context. Every breakout has a story. Every rally must be examined through the lens of who benefits from it. Once you train your eye to see distribution concealed within apparent strength, you stop buying at the most dangerous moments. You stop chasing euphoria. You begin to understand why professionals sell into strength rather than weakness. Volume confirms intent more reliably than price alone, and once you internalize this idea, your entire perception of market movement becomes more dimensional. Price is loud, it screams, it grabs attention, but volume whispers the truth of what's happening beneath the surface. Most traders focus almost exclusively on price because it's visible, dramatic, and easy to interpret at first glance. But in the Wyckoff method, volume is the real interpreter of motive. Without understanding volume, a trader is often left guessing whether a move is genuine or deceptive. Have you ever seen a beautiful breakout fail instantly and wondered why it happened despite the strong price bar? When you study price alone, you see outcome but not participation. You see the final print, not the struggle underneath it. Volume tells you how much commitment exists behind that move. A price rally on weak volume may look impressive, but if participation is low, the move lacks sponsorship from strong hands. It may be driven by short covering, emotional buyers, or simply a temporary imbalance that won't last. On the other hand, a modest rally on increasing, steady volume reveals real interest. Intentional accumulation by those who have enough influence to move the market sustainably. This distinction is crucial when analyzing market campaigns. During accumulation, the composite man quietly absorbs supply. Volume tends to decrease overall because sellers become exhausted over time. But within that decreasing structure, small hints of increased volume on rallies suggest strong hands supporting the stock. This is how volume reveals intention, even when price appears flat or directionless. Without volume as a guide, the trading range looks like randomness. With it, you begin to see the fingerprints of accumulation forming. How many times have you looked at a sideways chart and dismissed it simply because nothing is happening? The same principle applies during distribution. Price often rises or hovers near highs, creating the illusion of strength, but volume tells you whether the move is being fueled by real demand or simply propped up so larger interests can sell into it. If volume expands on rallies and fades on declines, it often means supply is entering the market quietly. Traders without volume awareness get fooled by the appearance of strength. They see upward movement and assume demand is strong. But if the composite man is selling into that strength, volume will reveal his presence long before price does. Think about how price behaves in a breakout scenario. A breakout accompanied by strong, rising volume suggests genuine demand pushing through resistance. Strong hands are participating. The market is accepting higher prices, but a breakout on low or average volume is often a trap. The breakout has no sponsor, no foundation. It's running on fumes, often driven by inexperienced traders reacting emotionally. When the Composite Man tests the breakout by letting price dip slightly, demand fails to appear, and the breakout collapses. Traders who entered on price alone find themselves on the wrong side of a move that volume had already warned them about. Volume also reveals exhaustion. At the end of long trends, whether up or down, climactic action often emerges. You'll see massive volume spikes, wide price bars, and emotional reactions from the crowd. In uptrends, this marks buying climaxes, moments when the public buys aggressively while strong hands quietly begin distributing. Price surges, but volume tells the truth. The market is near a turning point. In downtrends, selling climaxes appear when panic grips the public and volume erupts as weak holders finally capitulate. Without volume, these moments look chaotic. With volume, they look meaningful and even opportunistic. A powerful but often overlooked aspect of volume is how it behaves during tests. The Composite Man frequently tests areas of prior activity to gauge how much supply or demand remains. A successful test often shows low volume. This means the opposite side of the market has diminished. For example, after a spring shakeout, if price rallies back into the range and then dips slightly on very low volume, it signals that selling pressure is weak and the stock is ready for markup. Traders focusing only on price may misinterpret that small dip as bearish. But volume reveals its true nature, a lack of supply rather than the presence of sellers. Isn't it interesting how often the market fools those who look only at surface level movement? Volume also helps establish the path of least resistance. When price approaches a level of resistance or support, volume behavior shows whether the market is absorbing orders or rejecting them. If price stalls near a resistance level but volume expands on each approach, it may signal absorption, strong hands preparing for a breakout. If price approaches support but volume increases on down moves, it may signal supply entering aggressively. These insights are invisible to traders who focus solely on price patterns without considering participation. Learning to read volume is not about memorizing signals. It's about developing sensitivity to what the market is telling you about who is active and why. Volume is the language of commitment, where strong hands reveal themselves unintentionally through the size of their actions. It cannot be fully hidden. Even in quiet markets, subtle changes in volume structure can tell you whether preparation is underway. And when you combine volume with price in a thoughtful, Wyckoffian way, your analysis becomes more grounded, more objective, and less reactive. By giving volume equal weight to price, you begin to see chart behavior with a depth that most traders never develop. You stop falling for superficial strength. You stop assuming that all rallies are bullish or that all declines are bearish. Instead, you read intention, quietly, patiently, and with clarity that grows over time.